Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Chris Miles. Chris, the anti-financial advisor, teaches entrepreneurs and professionals how to get their money working for them today. He's an author, podcast host of the Chris Miles Money Show, has been featured on U.S. News, CNN Money, Entrepreneur on Fire, Bigger Pockets, and has a proven reputation with his company, Money Ripples, getting his clients fast financial results. In fact, he has helped them find over $250 million in the last 9 years. So Chris, goes in detail why he's an anti-financial advisor. And he started out as a traditional financial advisor, but he realized his calculations would not actually make people financially free. And so then he just struggled with that, right? Is this just ethically, is this right? What I'm doing, how I'm advising people. And so we talked about that calculation. He went in depth about that and why you should stop funding those 401ks and IRAs and some different things that you should be doing. And he went back, in pros and cons, mutual funds, real estate, the differences. And, it's going to be a good show for you to listen to and think about what you are doing with your IRA or 401k and how you're investing. But quickly, I want to tell you about a sponsor who we have partnered with personally, as well as we are just growing our investor base and we want to continue to build that loyalty. And it's a company called lifelonggifts.com. I encourage you to look them up. They're going to help you to send gifts to your investors or to send gifts to just people that you love, especially right here before the holidays. You know what? I mean, you can get a nice gift sent and have that person's name even put on it. It can be a nice knife set or a cutting board or lots of different things. They have so many different options that's going to allow you to have that personalized touch with that individual, with that person maybe that's done you a favor, and you're wanting to say thank you. And we want to say thank you to our investors all the time. I can't send enough gifts, but I just want you to look up lifelonggifts.com. One of the owners there is a friend of mine, and they are just providing an amazing service to entrepreneurs and people who are building that loyalty component, which you hear me talk about often. Chris, welcome to the show. I'm glad we finally made it happen. We were talking beforehand. I know I've had some technical difficulties and we rescheduled, but you have some skill sets that I know the passive investors listening for sure, but even the operators that are listening need to be aware of. And I'm just looking forward to getting into it today. But tell the listeners a little bit about yourself and those skill sets so we can dive in.
Yeah, you bet. I appreciate being here, Whitney. It's been an honor to be here for sure. And I'll tell you the biggest thing that I did, I'm basically an anti-financial advisor, right? I started out as being the traditional financial advisor almost 20 years ago. Did that for 4 years. Once I got the real numbers, like what's the real return of the stock market and inflation and everything else, I started to realize that my calculations wouldn't make anybody financially free. And so I had this dilemma. I had to figure out, am I going to keep doing this because my pocketbook says to do it, or am I going to stay in integrity and get out? And especially after I met a guy that wasn't in real estate investing, he was an active investor and he was creating a lot of cash flow fast. 2006, I said, I can't do this stuff anymore. I'm out. I'll never teach about money again. I will just be a mortgage broker and teach ballroom dancing on the side and stock coach as well. And so I did that for a time, but I had to know what these guys knew. And eventually I was able to become financially independent myself by the summer of 2006. I was almost 29 years old, went through the recession, got my butt kicked, especially because I was banking on appreciation. So I came out much wiser this time around. And I was able to become, even despite not filing for bankruptcy, was still able to dig out of that $1 million debt hole and become financially independent the second time at the end of 2016. And that's basically what I'm doing now. I'm working as that anti-financial advisor, beating that same drum, telling people to stop funding those crappy 401ks and IRAs and really just, become free, like go for these passive alternative investments that have less risk with greater returns versus doing the same old high risk, mediocre returning stock market stuff.
Okay. So what I heard there was was we need to learn ballroom dancing to achieve financial independence. Is that right?
Well, dance and finance rhyme, so they got to be related somehow.
Yeah,
right?
no, I'm kidding, of course. But well, tell me a little bit about that calculation, though, or people that are going to that financial advisor. It's interesting. You say, you know what, I figured out my calculations. We're not actually going to give them financial independence. Help that listener to see that a little bit more, maybe about their own scenario that they haven't noticed before.
Yeah, there's a difference between average returns and actual yield, right? For example, average returns, they'll say, hey, we've averaged 10 or 12% since 2000 BC, since the Romans conquered, Rome, or, well, whatever they conquered, right? But, since for the beginning of time, right? Well, the problem is that average does not mean actual, especially whenever you have a negative year, the numbers get thrown off. Right? Because, for example, if you've heard this situation before where someone has, say, $100,000 in their IRA, they lose 50% that year because the market tanks, they're down to $50,000. Now, most people, including myself as a financial advisor and all the other financial advisors I worked with, would tell you, hey, well, then you just need a 50% rate of return to get back to zero. But a 50% return on 50,000 is only $25,000, meaning you only got up to 75,000. So in reality, that 50% loss needs 100% gain to get back to zero, not including the costs they're already pulling out each year, right? So when you think about it, that average return, minus 50 plus 100, that's 50 divided by 2 years. That's a 25% average return, right? And that's what they all teach us. They tell us, everybody, hey, we're going to teach average returns because, of course, what makes the financial institutions more money? Average returns, not showing the actual yield, which would have been zero or less than zero in that situation when they take out their fees. They'd have you probably have $97,000 left, that's what we don't want, right? We don't want that kind of situation. So when I found out the real rate of return on the stock market, it was much less. It wasn't 10 or 12%. In reality, even right now, as of just a month ago, the average return was about 8.4%. That's the actual yield of the return. So that doesn't count all the costs coming out of your fund. Even if you invest in ETFs, they're still pulling out costs, right? But you're lucky to maybe average 8%. And this is after the 13 years straight up, that we've had in the stock market, which has never happened in history. At most, we've seen like a 6-year run up in the stock market, not 13. So to see this 13th up year in 2021 is just ridiculous. So even 8.4% is overly optimistic. Really, between 7 and 8 is more realistic, right? So think about that. If you've been telling people 10 or 12% and compounding that, which gets you a much higher return, but in reality, you're maybe getting 7%. It's ridiculous. You take these high risk and mediocre returns, where you and I both know in real estate, whether we're doing syndications, we're buying our properties or wherever it might be, we go for at least double-digit returns, like a minimum, a 10% return, total overall. I mean, that's a completely different factor. Plus it's cash flow in many cases, right? So if we're getting cash flow, steady income streams from this, it's a whole nother level, because even if you're lucky enough to save up, say $1 million into your IRAs or 401ks, the problem is that you should only be pulling out maybe 2 or 3% in retirement so you don't run out of money. 4%, way too much. That's an old number. Even 20 years ago, we were debating 4% being too aggressive. So think about it. You have $1 million, you're pulling out 20 or 30,000 a year. I mean, that's living below the poverty line as a millionaire. You're a broke millionaire. Versus if you have $1 million, that's working in the syndication, paying you 10%. That's $100,000 a year with tax advantages, especially if you get all the depreciation and everything else passed on you. You're keeping more money versus paying taxable 20 or 30,000 a year. So that's the difference. That thing blew my world wide open in 2006, and I was like, this is crap. I can't teach this anymore, especially knowing that you can do something better with less risk and get better returns.
No, that right there, we could just end the show right there, because that should tell people. I mean, from the things you just mentioned, we should be thinking about our quote financial advisor, right, and how we're being advised, and think about what real estate can do for you. But you said stop funding the 401ks and the IRAs, and what should they be doing instead?
Yeah, you know what? It's funny because the 401k, the biggest argument people give me is the match, right? They can say it's tax, I'm tax deferred, but the truth is it's a tax delay to a future date. Do we really think their taxes are going to go down in the future? The likelihood is with inflation, everything else, you have to pull out more money in the future. Even if tax rates stay the same, you need more money to live on. You're likely to be in a higher bracket, right? So that's a dumb argument. But the match, That's the one that everybody like gets hung up on, right? Even intelligent people, they're like good savers. Like I put in max fund in my 401k and then I get the match.
It's free money.
Exactly. Right. It's a no brainer. Besides, if I only match up to the 6% or whatever, when I get that 100% match, well, that's 100% return. So I actually just recently did a podcast on my own show, on the Chris Miles Money Show. I did a podcast where I showed the numbers. I said, let's just say that you only make $100,000 a year. You're putting in 6%, $6,000 a year, and you get the match, right? 100% match. So I put in 107% return because they always say, well, it's 100% return. Cool. Well, let's put 107% into a compound interest calculator, see what happens. 6,000 a year at 107% return in 40 years, $50 quadrillion. Not trillion, not billion, quadrillion. You're richer than Bezos in 40 years with your crappy little 6,000 a year you're putting in your 401k. Come on. Like nobody. And in fact, the average 401k right now only has a few $100,000 in it for the retirees, right? They're only about $250,000 average after saving. Now it's been 35 years since the 401k really came on the corporate scene for average people. So these people have been saving for 30 plus years, only have $250,000. And some of them were max funding too, right? So that's the thing. And I'll meet people, and you do too, I'm sure, where they've got maybe a couple million because they're like dentists and they've saved up a ton of money into them and stuff and just packed it in there. But the truth is that you don't make that great of return. By the way, the match only adds, if you even get that 100% match and that's all you do, it only adds over a 40-year period about 2.5% compound interest return. So you go from a 7% average to 9.5%. If you do max fund though, and then you get like maybe several $1,000 on top of it, it only adds about 1% a year to your return, not 100, 1%. So now you're up at 8%. And then you get taxed on it. If you're even a 33% tax bracket, now you're losing almost 3%. You're like netting 5% return versus, again, I can make double digits investing in real estate easily with tax advantages, right? And again, the cash flow that comes in is just huge. I mean, $1 million live on 20, 30,000 a year or 100,000 a year. That's your choice. It's just, to me, it's a no brainer not to do the 401k and not to get the match. Plus the rules are always changing, right? Like we were always talking about before the show about, now they're talking about maybe changing the Roth IRAs, which was like the little darling for some of our investor friends. Like, oh, well, I don't do the 401ks and IRAs because I get it, but that Roth IRA, that's the answer. Not realizing that the main partner in any qualified plan is the U.S. government. They have controlling interest of your little business venture together, not you.
Are there any other things around that change that you could share with the listeners?
Yeah. I mean, again, it's only been proposed. It's not sealed yet as of, the recording of the show, right? This could change even in the next few weeks, but what they're talking about doing is basically tax the rich and give to the poor, right? So if you're actually successful with your Roth IRA, which most people aren't, but even if you're successful in life, if you have over a $10 million net worth, you're required that year to cash out 50% of your Roth IRA, even if it means a 10% penalty on your money. So a 50% you got to pull out year one. So again, the government needs to fund this. And by the way, they're looking at this because here's the crazy thing is Biden promised not to raise taxes on anyone making less than $400,000 a year. Oh, by the way, if you make over $400,000 a year, they're going to say no more Roth IRAs for you, right? So that's another issue, which I'm like, who gives a crap? Like they suck anyways. But you can't fund a $6,000 a year and hope to become wealthy, right? But
so make you pull 50% of it out and make you pay the penalty.
And pay the penalty, right? So if there's any gains and everything else, you're paying on that. So that's ridiculous, right? I mean, that's the thing is that again, if you're rich, because again, Biden doesn't want to tax anybody over $400,000 a year. Now, so his only other options that the government, even Democrats, are trying to come up with is they try to put on a tax on cigarettes, but of course, there's people that make under $400,000 a year that smoke cigarettes. So, well, we don't want to do that because now you're taxing. He's breaking his promise, right? And they're going to rip on him in the campaign. The other thing they're trying to tax too is like, even like gasoline and things like that. Well, that still affects workers. Even if you tax corporate America, of course, the thing they're going to have to do is they get more corporate taxes. They're going to pass it on to the employees. And that affects, middle and lower income class Americans. So he's kind of caught in this dilemma. So they're trying to find any way possible to fund all these stupid programs. And the Roth IRA, or anything, IRAs, 401ks, don't think that these things are impervious. They could all of a sudden say, you know what? Yeah, you are technically rich. You got a couple $1 million in that IRA. this year, you're going to get taxed right now. They can change that rule and you have no say in the matter.
Yeah, that's scary. Maybe disappointing to a lot of the listeners hearing some of those things or potential things that could be happening. But what should they be doing, Chris? And I know we've talked a little bit about. Maybe you can elaborate more on the differences between how people have been investing in whether it's mutual funds or whatever to real estate and what they should be doing to maybe achieve that financial independence.
Yeah, I mean, definitely real estate. Of all types of forms, right, is a great way to go. There's no doubt, especially if it's lower risk, you're creating, good steady returns, or you're getting good cash flow, or both. I like cash flow and growth investments. Those are always great when you get a preferred return plus some growth, potential on it as well. Right. I mean, there's lots of different ways you can do it. You can always fund it in cash because at least you don't have to worry about keeping it locked up in some qualified government plan that they're going to try to change the rules on you. Right. The other thing I use where the rules don't change because it's a contract is I use life insurance. It's the only thing that's taxed like a Roth IRA, but I don't have all the limits of like 6,000, 7,000 a year you can put in. I can put in up to 25% of my stated gross annual income, right? I can fund the crap out of those things. And then I use it to invest, which then I get to double dip. I get to make money inside the policy and at the same time, pull the money out as a line of credit and use it and invest in other places. And I end up making at least another 2 to 5% on top of whatever the real estate is paying me. So that's kind of been my replacement. And I've been using that for years. And the great thing is, even if they change the tax rules, as long as you get in the contract before the rules change, then it doesn't matter. Like it's grandfathered in, you get the same tax rules as before.
Okay. No, that's good to know, right? I mean, that could be scary for a lot of people thinking about moving into that type of investment right now, thinking, well, it's just going to change. Well, and maybe you need to do it, before it changes. Right. Mm-hmm. So how else do you advise people, or what maybe some fears that people have in moving this route versus, it's just the way we've been raised, right? I mean, a lot of us, I think, this is what you do, right? You get that free money, and you don't want to pull out from that. I know parents often, depending on when they were raised, if they were not entrepreneurs and think like this, man, it makes so much sense, right? My grandparents lived through the Depression, and it just, that would just make sense to them, right? This is safe, secure, you're getting that free money. Man, why would you not do that? But any other fears or myths that people have that you want to speak to?
There's a lot. I would say the big one I hear often is someone will tell me I'm a conservative investor, right? Which is not true. One, if you're in the stock market, you're not an investor, you're a gambler. Let's be honest. You have no control over the outcome. Zero control, and it can change on a dime. I mean, we recently saw the stock market dip, like the Dow drop like 800 points in a day, all because people were scared, just fear about China's debt, right? And China's markets could be collapsing too. And that collapses, that caused the US to collapse, right? So we have all these little uncertainties there. So when someone tells me like, well, I'm a conservative investor, I put money in my 401k or my IRAs, I'm like, you're not conservative. You're a comfortable saver. Because one, you're not an investor, you're a gambler. Two, you're just saving. So really you're a comfortable gambler. Just because everybody else is doing it, you think that because it's conventional, that's the conservative thing to do. But the truth is that the majority of Americans are gambling way too much. They take way too many risks with their money, and that's why they never become wealthy. We don't want to follow the masses because the masses become broke. Even if they save a lot, they still don't save enough. I even had a guy I talked to who was 53 years old recently. He saved $3 million in his IRAs and 401ks. And his financial advisor said, good, you're on track. Keep going. In 12 years, you should probably hit your goal. But the thing is, he's like, you know what my goal is, Chris? 500,000 of passive income a year. And I said, well, if you want 500,000 a year, you got to get that number up to 15 million. You got to quintuple your money in 12 years. So most likely you're going to be working into your 70s or 80s to hit that number. And he's ahead of most everybody in America, right? And even him, he's like, I won't quite get there. No, don't do that, buddy. Like we can get that money, that 3 million work for you now, and we get you at least 300,000 a year today, right? We can do that. We can get you at least 250 to 300,000 a year, and it blew his world up. But again, he was he realized he was that comfortable saver, right? He was comfortable doing the mainstream, but he realized, like, wait a minute, of all people, I should be financially free right now, and I'm not. And so I tell people, like, no, you're not conservative. Guys like Whitney and I, we're conservative. Like we want to take as little risk as possible to maximize our gains and our returns. We actually want the sure thing, the real thing, real assets, not zeros and ones on some paper, which, by the way, the stock market now is 90% traded by AI. In fact, there's 70,000 trades done in a second with AI that humans can't do. So humans have almost no influence right now over the stock market. Is that really where you want to, really like put your safety and your life into? Do you really want to be in that place? To me, that's just too much risk with too little return.
I knew there was a lot of AI making trades, things like that, but I didn't realize it was that much. Wow. Yeah. And how can you compete with that? Right.
You can't. Even somebody, I taught people how to trade stocks and options back in the mid 2000s, right? Even today, the rules are so different because it just doesn't act the same. All they have to do is they just look for like keywords and stuff in articles, and they're like scanning everything to figure out when to buy and sell. I mean, it's just a big algorithm right now, and that throws everybody off. Now you can't always trade the same way you could have before, where it's a little bit more predictable, even though that was still high risk.
Chris, I meant to ask you earlier too. I know you have a story behind like how you lost properties by going too big. What does that mean?
Yeah. So in the last recession, like I basically had a lot of ego, right? Because I felt like I had the Midas touch. It seemed like whatever I touched turned to gold. I remember doing it right, where I was focusing on cash flow, got me out of the rat race by 2006. But, the thing is, I started thinking about appreciation, right? And I know you know this because as a syndicator, especially, you can't just be banking on appreciation necessarily, even though you can manipulate it more, especially with value add properties and things of that nature. But you can't really. It's kind of more of like icing on the cake. It's not.
We don't count on it. You're not underwriting it. That's right.
Yeah, that's why you need the cash flow. You need the profits, right? Well, I took my eye off the prize. I stopped focusing on profits. I even had negative cash flow in properties because I thought, well, hey, if this property appreciates 10%, offset the losses. I'm good. Well, of course, when the recession hit, things weren't appreciating anymore. And then your negative cash flow, it's not profitable. You're basically sucking money out. And so I found myself, trying to like sell off properties really quickly. Even if I had equity, they were gone. Even my own house, I had to foreclose on because, good old Lehman Brothers didn't want to accept any short sales at the time. So they ended up short selling for $170,000 less than the offers we had on the property. And so it took me from millionaire to upside down millionaire status because I started gambling and banking on appreciation versus focus on the thing that worked in the first place, which was cash flow. The thing that to me now is sexy. Boring is sexy to me now, right? Before it was always about like, hey, like those big returns, that's sexy. Especially when you're in your 20s, you get dollar signs in your eyes, you get stupid. But when I realized that the sexiest thing is how boring can I make it? Like how predictable can I make these returns? That to me is way sexier. $400 a door, $300 a door. That's sexy to me, versus, trying to, bank on, 50,000 on a flip or whatever it might be. So that's where I went wrong.
No, that is some great advice right there. I mean, cash flow is so important, right? Mm-hmm. And never to bank on, just dreaming of appreciation, right? You do hope that happens, but man, you don't know that for sure. No, I appreciate you being willing to share that as well. I think that probably speaks to a lot of the listeners, also. And, thinking back a little bit, even thinking about that, what would you say to that listener that maybe has some, or is looking at deals like that now, or maybe what you would have done differently? I know you said a little bit, but like going from thinking with the way you were thinking then to the way you think now as an entrepreneur. I know you said, how did you word it? Like simple businesses, right? Nothing complicated, boring is better. Anything else around that would be helpful for the listener?
Yeah, I'd say stay in your lane. Like I met with a guy that's a syndicator as well. And, he's like, you know what? I was going to do this and this. I've done tax liens. I've done that and that. He's like, but then I decided I'm just going to stay with new construction, That's it. I'm not even going to buy existing. I'm not going to do value add. I'm just going to focus on this one little piece. And I was like, great. I would trust you way more than like if you're a syndicator trying to go and invest in a marijuana farm, like all of a sudden you're like, hey, I think I'm going to try that. Honestly, as an investor, and I'm a much more passive investor now, I'm not as much of an active investor. I love when people stay in their lane, but if they're like, hey, I'm going to go try this. Well, cool. Well, I'm not going to give you money to be my guinea pig, or to be your guinea pig, right? Like go test it out, try it, not just once, but try it several times. And again, I love experience. Even if somebody got hosed in the last recession, great. Did you learn from it? Would you learn how do you do business differently? Those are the people I love investing with as a passive investor, right? So I would just say, if you're a passive investor, look for that experience. Look for those that, if they got hosed, great. What did they do differently now that they weren't doing then? And then if you're a syndicator, you really focus on what it is you do best. Which markets are you best in? Don't try to find these brand new markets and then you have no clue how to manage it, right? Like just stay in your lane, stay focused, do what you do best.
Yeah, a lot of value in staying in your lane. And one way that we have grown but still staying in our lane is adding team members that have those expertise in the other areas, right? Or markets or things like that. And so that's been very helpful. So we can stay in our lane, or we bring people on that are already in the lane we want to be in, right?
Yeah, you partner with somebody who's already in that lane, and then you get a brand new lane now.
Yeah, no doubt about it. Chris, for that investor that's listening, thinking about, maybe a potential downturn coming up, I always like to ask, how do you think about being prepared for a potential downturn, as an investor or operator, either one?
Yeah. I remember in March 2020, when everything was kind of, up in the air and, market was starting to tank and everything else, the advice I would give that I still kind of adhere to today is get lean, get liquid, and get out, right? Like lean, even in your business, especially if you're actively investing in real estate, right? Make sure that you're really lean on your costs. Again, you don't have to be dirt cheap. Same thing in your personal life. I don't want you living in a cardboard box. I don't want you living on rice and beans like, our good old friend Dave Ramsey says. Like that advice is no good. But you do want to be wise. You want to be a wise steward of what you've been given. And so how do we really look at that? Analyze what's a productive expense and what's not. Again, still enjoy life, but don't be careless with it. Like really get those expenses under control. And while you're also managing and tracking your income and the revenue coming in. So that's get lean. Get liquid means you need to have cash on hand. One mistake I do see some people doing, especially if they listen to a lot of these podcasts, is that they try to deploy money everywhere and then they have no money to deploy at some point. In fact, they may not even have any savings for emergencies. So if they were lose their income, would they be toast? So definitely stay liquid. And we saw this even in 2020. Some people became non-essential businesses. This is why you want multiple streams of income, right? But you definitely want to make sure that you also have liquid cash just in case of bad emergencies, or two, it could be the best opportunity in the world. Because maybe that deal comes around. You're like, this is a once in a year or once in a decade deal. I got to be in this. You want to say, well, I'm out. I'm glad my money's over here. It's all deployed, but I have no liquidity. So get lean, get liquid, and then get out. We're not going to recommend you bail out of the stock market, right? But if you've got money in stocks right now or Bitcoin and things like that, where you've seen a lot of growth fast, this may be the good time to take profits. This may be a good time to get out, to be able to get that money out. Again, we're not recommending anything because everybody's individual situation, right? And we don't make recommendations like that. But, this could be the best time to take profits and say, cool, now can I move it somewhere more certain? Can I get it somewhere now and get more predictable returns? Because again, 13 years in the stock market up, it's got to correct. It has to, I was saying that even 6 years ago when I already went 6 years in a row saying, this has got to happen at some point. And look at where we are right now. I thought there was going to be a Y2K16. I even made fun of it. I was like, hey, there's going to be a Y2K16. Watch out. Didn't happen. Trump got elected and then things skyrocketed, right? So you got to be careful. Like you don't want to be gambling with that money. Get your money in certain places that you will make certain returns.
How liquid would you recommend?
It depends. Because if you're looking at just emergencies, you might just say 6 months of expenses or 12 months, depending on what you feel comfortable with, right? But, the thing is, you might still want to have some money in that war chest just in case of opportunities too, because you don't want to use your emergency money for that either, right? So it depends. You might say, hey, I'm going to take whatever my emergency reserves are plus $100,000, right? Just in case that great deal comes by, I've got some liquid available cash right now. So for some people, that could easily be 150, 200 grand. You might be keeping liquid.
You don't have to tell us if it's in a jar in the backyard, but I wanted to ask, where do you feel secure keeping that emergency fund? Do you feel good keeping it in the bank or is there some other type of way you like to keep that? And again, if it's in the backyard in a jar, don't tell us, but how do you do that?
Yeah, no, we did buy a bigger backyard, but not for the jars, right? that was for growing fruit trees and stuff, which is another reserve, right? But I would say this is, the best, I mean, you definitely don't want to be putting it all in the bank because you're earning point nothing percent and then you get taxed on point nothing percent. I remember my wife, she said, I want to keep 200 grand liquid for at least a year's worth of expenses that we have just in case, right? In case we had no income for a year, we've got enough. And so I said, well, I'm not keeping 200 grand in the bank at 0.05%, right? So I said, let's do this. And I have my life insurance, whole life that I use. I said, I'm going to earmark 2/3 of this. So about 130 grand in that account that we don't touch. Anything above the 130 grand, great. I can go and invest and double dip and make returns in two places. That 130 grand, I at least leave there where I know I'm going to make at least a 4 or 5% tax-free return versus 0.05% in the bank, or even 0.4% with my Capital One online savings account, that then I get taxed on that 0.4%. So that's what I do to kind of diversify, keep it liquid, but I can still get to it very quickly and at least make some money, try to keep it safe from inflation, which has been going crazy lately.
No, that's incredible. I wanted to get your take on that because I know there's people or investors that I talk to often are listening thinking, okay, I want this reserve or I want this emergency fund, but do I really want all that just sitting there, Yeah. And so I appreciate you elaborating on that. And quickly, what's a daily habit that you're disciplined about that's helped you achieve success?
Yeah, I have a morning routine. I think a lot of successful people have something like it, right? Tony Robbins called his the hour of power. There's like the morning rituals and all that kind of stuff, right? But for me, I do the same thing. I focus on 3 key areas. I call it the 3 E's, right? So exercise, education, and enlightenment. So body, mind, spirit, right? So I'll go and I work out. I'm actually now a marathoner as a result of this. So I actually just qualified for the Boston Marathon just a few weeks back. And now it's like, cool, what else can I do? But even when I do that, like this morning, I was doing a prayer of gratitude while I was out for my 10-mile run, before it started hurting, I make sure I'm more grateful, but started doing like prayer of gratitude, and do things with meditation. You can do things with journal writing. For the education side, you can listen to good audiobooks, whether you're working out, driving to work, whatever it might be. Learning, I always try to learn about different things on the financial end, or some things are personal development, but always just feeding the mind, body, and spirit first thing in the morning to get that big win. And I'll tell you, that's the one thing that helped pull me out of the worst times, like during the recession. And it's also helped me continue to thrive even when things are great.
No, well, congratulations to you, by the way, just coming back from a loss, like that, and making it happen now and doing so well. And even keeping that morning routine, I think it'd be very easy to give that up, during a time like that. How do you like to give back? Teaching. I mean, that's a big thing. A few years ago, obviously 2016, I was financially independent. I could have just kept doing 5 hours of work a week, just by managing my podcast and doing a few things that way and joint ventures. But I'll tell you, like, anytime I try to retire, people want to pull me back out and say, well, how did you do it? Right. And so that's what I kept doing. And a couple of years ago, I got to the point where I said, I can't keep doing this. I'm now getting up to 20, 30 hours a week. And so I started building a core team around me, and that team allows me to grow and expand. And that's got me excited. Like, I used to be a control freak, but now I'm kind of like, hey, I like relinquishing control to those that can do it better. And allows me to expand that ripple effect. And so that's really what I'm here to do, is create that ripple effect in people's lives. And because as I bless their lives with what we learn and people become free themselves, they can spread that ripple effect throughout. They can be better servants. They can be better stewards of the resources. They can teach their kids to create a legacy beyond them. I mean, if everybody could do this and what we're talking about here, if everybody could create that in their life, this would be a completely different world than what we're seeing today. Chris, it's been a pleasure to get to know you better, have you on the show. Just grateful for just all the value you provided to the listeners today. I mean, really, even just thinking about you being like anti-financial advisor, like you talked about, but helping us think through, hey, that 401k IRA, the ways that we've almost been ingrained to think about those, right? And that quote, free money, end quote, so-called, and that keeps us tied in there, right? Tied to that broken system, really. Just thank you for opening up really our minds to that and sharing ways to get out of that, better ways to be better prepared and investing in real estate instead. But how can the listeners get in touch with you and learn more about you? Yeah, 2 ways they can do that. One, they can go to our website, moneyripples.com. They can get great free information on that. Or 2, you can follow my podcast, The Chris Miles Money Show, where, we talk about all kinds of topics. In fact, I think we even had you on recently, or within the last year or so, we had you on as a guest too. So
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.